Hello and welcome to Traditional Technical Patterns. Today I'm going to look at a lot of different patterns that we will come across when we are doing our technical analysis, looking at charts. I will try to teach you how to detect them, how to use them in your trading, and that's more importantly, that is how you apply stops. So let's start. With the traditional patterns, there are more than 100 different kinds. We are not going to touch upon all of them, just about a handful, a little bit more. And we will come across both continuation patterns, but most of them are also bottom and tops patterns or reversal patterns. What we can also say is that the more times a price touches each trend line, so all patterns are consisting of trend lines, at least two trend lines, usually two trend lines, sometimes just one where it's a support or resistance line. The more it touches it, the better the quality, meaning less white space if you have a white background on your charts. If you have a black background, well, then it is less black background between the lines, the better quality of the pattern, and usually resulting in better target performance or breakout performance, but it's not a guarantee. Also, usually the price needs something to reverse from, meaning most patterns are reversal patterns or continuous patterns in up and downtrend. Exception is, of course, sideways channels. So if you have a top or bottom pattern, it needs something to reverse from. And I'll get back to that in a little bit later when we dig a little bit deeper into the various patterns. Then, after breaking out, you need to look for confirmation. And that can either be a surge in volume or other studies and indicators. And one of the indicators could be RSI, which you can find in a previous webinar that I have done, or video that I have done, that you can check out and see, okay, if a price is breaking bullish out of a pattern, maybe a triangle or a wedge pattern or something like that, is it also being confirmed in the RSI? Finally, be aware of pullbacks and throwbacks. That's where the price jumps back into the pattern, or at least try to get back into the pattern after breakout. And when we are talking about targets after breakout, you can calculate that. And here we can use different measures. And I'm going to talk about rule of thumbs today, not at the other ones there, because there's also what I call the Bulkovsky rules. And Bulkovsky, I'll talk a little bit about him at the end of this video, where you can look for more information and learn more and read more about technical patterns. But Bulkovsky has done a massive statistic material on how much actually after a triangle breakout or a wedge breakout or whatever, the price has actually moved in terms of percentage. And there are some levels you can use there. A lot of them actually combines fairly well with Fibonacci levels, so we can actually use Fibonacci also to calculate how far we can move. We're not going into that today. It's a little bit more complicated, and then will be very long video. So I was just here in this webinar talk about how you can detect the patterns, add your stop loss and potential targets. Because remember, targets are not the most important one, stops are. And at the end, we will also look at support and resistance levels, and there will also be some support and resistance levels in some of these patterns. So let's start. If we start with one that a lot of you guys probably have heard about, is shoulder head shoulder. It is always a reversal pattern. It can't be in a sideways trading, and I'll give you some example later. So it's a free valley pattern. It looks quite a bit like a person with a head and two shoulders. We have the left shoulder and we have the right shoulder. So price is much reversed from something, and volume is usually falling, meaning it's usually highest on the left shoulder and then declining until the breakouts. Then confirmation with breaking the neckline, and neckline you draw from the two valleys. You have the two valleys here, and then you draw the neckline. It is usually sloping upwards, sometimes downwards, and we'll see an example of that a little bit later. It will hurt the performance. It's usually sloping upwards or is horizontal. The two shoulders should be more or less at equal height. To calculate the difference between the, and this is how we calculate the target. We calculate the difference between the head, which is A here, and the neckline, and going vertical down and calculate that. And then we actually subtract that or add it if it's actually an inverse shoulder head shoulder, meaning a person standing on his head. That can also be a shoulder head shoulder, so it's flipped upside down. But here you can see we calculate the distance between the top of the head down to the neckline. Then we subtract it from the breakout price, and then we have a target, and then we place our stop. If market moves back above the right shoulder, well, that is our stop, and the shoulder head shoulder pattern has been demolished. Let's have a look at one that is actually, if we go back to 2007, 2008, and that was just prior to the build-up, as you can say, prior to the financial crisis. We have Dow Jones on a weekly chart. We had a shoulder, and then a valley, a head. That wasn't that much higher than the shoulder, but it nevertheless it was there. And then we had another valley, and then we had a shoulder. You can see they were a little bit sloping right, so it's not the most perfect one. But we had the neckline. We could draw the neckline here. So from the valley here, we have the neckline. So this is how we do it. We see that when it's breaking out, then we take the distance between the head and the neckline, and then we subtract it from the C, which is the breakout price. So then we project that lower, and then, okay, that is our target price. It wasn't hit at the first go. It rarely is, but it was hit a little bit later, as you can see here. But because what happened was the market pulled back the price on the Dow Jones index here, testing the neckline, and we often see that. We often see that the neckline is being tested from the underside, and then market is then heavily selling off, and then it actually hit the target, but it actually continued even further. That also sometimes occur. Here we have another one, and we go straight into it. So here we have actually Novo Nordisk shares. This is a weekly chart. As you can see, and if you've been following my other daily technical update videos, you can see that they have I've been talking about this for actually quite some time, about Novo Nordisk. So you actually have a shoulder up here, a valley, a head, and a shoulder here after a valley, but that valley was lower than this one over here, so it was actually a declining or a downward sloping neckline, and that will hurt the performance, because most of the sell-off has occurred. We have dropped a little bit lower here. If you can actually go and check out the charts, I actually dropped a little bit lower than where we were when I took this screenshot here. But it didn't move all the way down to the potential target. You see the distance from here, subtracting from the breakout price, and it actually pulled back a little bit, but then it continued lower. And I don't think it will move much lower, but that's a different story. But we have some really strong support levels down here, and since we have a downward sloping neckline, it will hurt the performance. Moving on to this one, and I saw this some years ago, actually more than 10 years ago, when someone was talking about, oh, there's a shoulder in this one. This is actually WTI crude oil a few years ago, and say, oh, we have a shoulder here. Let's see, there we have a shoulder, we have a head, and we have a shoulder. But you can ask yourself, there's something wrong here. And normally when I do this webinar live, or this video live, some people can see it and some can't. So this is actually not a correct shoulder head shoulder pattern, because remember what I said in the beginning, it needs something to reverse from. Shoulder head shoulder patterns, they are reversal patterns. But it looks like at first take it's a person standing on its head, but it's not, because it needs something to reverse from. If the price was coming from up here, higher up in the headline or something like that, well, then it would have been a confirmed shoulder head shoulder pattern. There could be other patterns, but this is not a shoulder head shoulder pattern, just to clarify that. Let's move on to another top pattern or a bottom pattern. It could be a double or a triple top. Triple tops are very rare, but double tops are not that rare. We see them from time to time, or double bottoms also. We will see a few examples here a little bit later. But again, they are also reversal patterns. So if we have the double top pattern, there is two peaks that look similar often. We have Adam and Eve tops. Adam tops very narrow or pointy, and Eve tops are more rounded. Or if they are bottoms, same thing. However, we could sometimes see one Adam top and one Eve top. So it varies a little bit, but it's not that important really. If we see three tops or three bottoms, well, the rules are the same. So what are the rules? Well, first of all, here we have a double top. So how do we calculate the double top target? So first of all, we are identifying having two tops that are more or less at the same price, quite close actually. It doesn't have to be exact the same price. Then we take the difference from the peak to the valley. This is the valley, that's B. And when it breaks below, we draw a horizontal line. It doesn't have to be horizontal on shoulder to shoulder, but here it has to be horizontal. We actually draw that line horizontally, and that is what we call the breakout price. We can, when we break below that, see we take that difference here, and we subtract the difference to the C, and then we have the target D. But where do we place our stop? Well, the stop will be if it takes out the top 8, which is the right top right here. However, if it moves back, we can have these pullbacks and start moving back above C, then you should maybe reconsider, is this actually a correct trade to take or not? And that's, of course, it's a little bit harder to estimate or to judge, but it will come with some experience. Here we have an example that's actually quite old one, but it's still very good because I use it in other examples also when I am working with trend analysis, and I will use that one also in a later webinar or later video. So here we have your dollar weekly, actually back to 2008. See, we have two tops here, and we have the valley down here. There was actually kind of two valleys. So double top confirmation when it breaks out, that was the target, but it actually continued a little bit further, actually quite a bit further, and we sometimes see that. And that's why targets are not that important. Let the profit run, but keep your stops tight. Another one, that's a more recent one, actually, we saw here in Spotify on daily chart here a few weeks ago. We have this double bottom. You can see they're not exactly the same price, but almost. So here we have this is not a valley, that is the opposite of valley, but we still have these two bottoms here. And the breakout price is around there where we have the dashed line. So if it was me, I would buy here at the first green candle where it's also closest above. Because I like confirmation, I want to close above the breakout price. That is your buy, and then you can calculate the target price with calculating distance from the right price or right bottom. And if it was flipped upside down, it would still be the right shoulder, so to speak. and up till the breakout price, or where the value here is placed, and then you add it to the target price, and it actually hit there, and then something else has happened. Right there you have your target. But again, targets are not the most important ones. If this pattern should have been demolished, well, it should take out the right bottom at A. However, what I would do if it was me, if I bought here at the after it closes above the horizontal line, after it closes above B, then I will actually place my stop at the last turning point. The last turning point, which is here. We had a little bit of correction, as you can see, and then I will place my stop right there below that level and say, okay, if it's being thrown back below that horizontal B line there, or C line, which it actually is, well, then I would place my stop right there. Moving on to triangles, and we will start with symmetrical triangles. So the price up until a symmetrical triangle can be any direction before it actually enters into this pattern. It consists of two converging trend lines. Price must fill the space between those trend lines as much as possible, and touch each trend line at least twice, so 4 times total. Breakout is about 75% of the distance to the apex, and we'll get into that a little bit later. But breakout can be any direction, so it can actually be both a continuation pattern, it can also be a reversal pattern. And it's like, statistically, it's 50-50 up or downwards. So here we have a symmetrical triangle. You can see that prices moved up, and then suddenly it's just whipsawed in a more and more narrow movement or price trends, and you can then draw two converging trend lines and wait for breakout, and usually around 3/3 or 70% of the way to the apex, and the apex is where the two lines meet. So how do we then calculate the target price after it breaks out? Well, you take the highest point and the lowest point, A minus C, and that distance or difference you add, if it breaks out to the bullish side, to the upside, and you add it to the breakout price, and then you have target D. And again, this is the rule of thumb. It is not given that it will actually also move to that level. It could be stopped a little bit earlier, or it could move even further. But the big question again here is, where do you place your stop? And that's where you do right there. The last turning point, or the lowest point of the last turning point, and then a little bit lower prior to the breakout. That is your stop, because sometimes you will see it being thrown back and testing the upper falling trend line after a bullish breakout. It will test the upper falling trend line from the other side and then take off. But if it drops back into the below the trend line, and especially if it takes out the last or lowest point there after the last turning point, then it will be busted, and then we have a completely new situation. So let's have a look at a symmetrical triangle, and it is a little bit old, but it's very beautiful one, and I'm also using it when we are actually talking Fibonacci, and there will be a Fibonacci retracement projection and all that video much later. But just to say, well, we have two trend lines here, and the thing with this one is it's actually Fibonacci levels being hit every time it did a little bit of turning point. So here we have peak and trough, calculate the distance, add it to the breakout price, and then you have the target, and then you also have the stop price. So that's your stop price. Not anywhere else. It should not be placed at anywhere else. If it's too far away, because this is the normal stop in the market. This is the normal stop in the market, and this is where you should place your stop. If that is too far away for what you are comfortable with, then don't trade it. Don't find another stop somewhere in between. You will probably just be stopped out or whipsawed, and then market will take off. Especially if it do a throwback. It didn't do it here, and it doesn't do it all the time, but it do it sometime. Here we have a symmetrical triangle. It's actually Amazon daily chart, and it's fairly recent. We can see right there, top, bottom, or trough here. Calculate difference, add it to the price, breakout price, and then you have target D up there. Sorry, I forgot the arrow. I think you can live with that. But again, this is also because this is actually the that's your right stop. That's the correct stop. You could also argue, well, it should actually be the next one. It should be this one. If you're a little bit more cautious, I will actually place it at the low of this this large bearish candle here. So you will buy here, and then you'll place your stop either here or here, and then you should be fine. Moving on to two other triangles, a little bit different, ascending and descending triangles. Again, direction leading into a pattern can be from anywhere. It could come, a downtrend or an uptrend. It also consists of two trend lines, but one of them has to be horizontal. It doesn't have to be 100% horizontal. It can slope a little bit, but not much. And price should touch each trend line at least twice, filling up the space between the price chart as much as possible. If it touches more times, then we are more happy. It's probably a stronger pattern, but at least twice, exactly like with the symmetrical triangle. Breakout, it's usually a little bit earlier, according to Bulkovsky, 2/3 of the way to apex. Ascending triangles usually lead 2/3 of the time to an upwards move, and descending 2/3 of the time to a downwards move. So let's have a look at an ascending triangle. Here we have an ascending triangle. You can see there's this horizontal line. It should have been pushed a little bit further to the left, but nevertheless, here we have the apex. But you can see here it's flat. The upper trend line is flat because maybe there's a strong resistance level there for some strange reason. And we're going to talk about resistance levels in a little bit at the end of this, horizontal support and resistance levels. But the bottoms here, they are actually upward sloping. They are higher and higher, so the lows are higher and higher. They don't have to be exactly on the line, but they shouldn't be too far off. So how do we calculate price target and stops there? Well, actually similar to the symmetrical triangle. You take the peak of the triangle and the trough of the triangle, calculate the distance, and add it to the breakout price. And then you can add your stop, and that is your stop. You can still experience throwbacks and pullbacks, and a throwback where market moves up, breaking above the horizontal trend line, and then it will test the horizontal trend line, which is now a support from the upper side, and then it will take off. If it starts moving below there and below the rising trend line, I will probably get out before it actually gets down to the stop, but you should, as a rule of thumb, you should trust your stop. However, if it breaks out, and I haven't taken an example here, but if it breaks out to the downside, meaning instead of breaking the resistance up here, the horizontal line, and breaks out to the breaks below this lower rising trend line, then your stop will be up here on the resistance line or a little bit above, and then you can calculate the target lower using the same rule, just calculating, subtracting it from the breakout price. Descending triangle, well, that is when the upper trend line is descending and the lower one is horizontal or almost horizontal. And again, you use the you take the peak and the trough, the distance here, and then you subtract it from the breakout price if it breaks out bearish, and then you have the target and you have a stop here. The stop is the last turning point before or prior to the breakout. Again, in rare cases, you will see it breaks out to the other side, and then it's a reversal pattern, and then your stop is down here at C, which is the horizontal line. And then you can calculate the target also. But again, targets are not that important. It is the stop that is important. Let's see an example here with Disney. Actually, current Disney actually broke above a horizontal trend line here. So we can see twice it got rejected after moving. You see up here, you had the uptrend, then suddenly, oh, it couldn't get up there. I don't know what price it was, doesn't really matter. I draw a trend line, and then you can see the lower rising trend line here. So we have drawn this ascending triangle-like pattern, and then, oops, sorry, that was a little bit too fast. And then you can calculate your stops. You take the highest peak and you take the lowest value and add it to the breakout price, and you place your stop down there. I hope you can see my cursor. That is your stop. Another example, MongoDB. It is a tech company. Currently, it hasn't broken out of its ascending triangle. Let's see if it will actually materialize. So what you can do on your own chart, you can put and have a look at MongoDB and see, will it actually break out? And which direction will it break out to? So that's a little cliffhanger there you can do yourself and see and work with it and see how it actually evolves. And I will probably also, if I remember it, talk about it and doing my daily technical update videos and say, now it actually broke out of what we talked about during this little educational video. Another one, here we have the ascending triangle, and that is actually Intel. Intel has done a lot of volatility. There's been a lot of volatility in Intel for a very long time. But then suddenly it has formed this descending triangle with a horizontal line here. You can see it's sloping slightly lower, but it's not sloping enough, so it's actually a wedge. So this is a descending triangle. You can calculate the distance from the peak over here and down to the bottom, and then you can add it to the breakout price, and then you actually have a potential target. However, again, the stop price is the most important one. That is where you see the lowest price here, where it turned around. So it's just around this horizontal line here. That would be your stop, and you ride the trend higher. And you can see actually first time it actually broke out of the upper falling trend line. Then it broke back into it. It got actually thrown back into it. And then you said, oh man, maybe it's not a breakout. And maybe if I bought there and say, oh, maybe, but I would have my stop there. As soon as I buy here, that is my stop. And I'll say, okay, I already made up my mind. I'm happy about that. And next day also it took off again. And then it has continued higher. Moving on to wedges. Rising wedges and declining wedges. And they are always reversal patterns. Always reversal patterns. So what are the rules? Well, first of all, again, trend can be in any direction leading to the pattern. The price and the two trend lines are both downward sloping or upward sloping. But not like triangles and not like symmetrical triangles. They are both sloping in the same direction, but not the same degree. And price should touch the trend lines at least 5 times, one of them twice and the other one 3 times. Never just 1 or 2, has to be 2 and 3. The more the better. And here's an example. You can see market has moved down, and suddenly the slope or the degree of the angle is flattening, and then suddenly it breaks out. So when we are talking about wedges, in the ideal world, wedges are actually at least 3 long for the duration of the trend to evolve. Otherwise, it's called a pennant, but it looks the same. So I really don't care if you call one of them the pennant or wedges. I know so many out there, they call them all wedges anyway. Breakout, at least 2/3 of the way to the apex, sometimes a little bit longer. And usually it's most of the time up. It's rarely down, and it's usually then when it's a pennant. Target price, calculate the peak of the wedge to the bottom or the trough of the wedge. You calculate that difference and add it. If it's a reversal one, you add it to the breakout price, and your stop will be down here. Then you can actually calculate that. Two rule of thumbs when we talk about target price. Price should at least get back to the peak of the wedge, which is over here, that's A. But as we can calculate the distance here and add it to C, it should be also able to push even higher. But as a minimum, it should get back to the last peak here or the first peak here, or the highest peak in the wedge. And if it's upside down, meaning it's a rising wedge, then of course everything is vice versa. And the stop, again, the last time price turned around prior to the breakout price. So here we have a falling wedge. It's an old one, but it's a really beautiful one. It's almost like a textbook one. You can see here we have a wedge market move down, forming a wedge. Broke out maybe around 75% of the way to the apex. Apex is where the two lines meet. Calculate the heights of the wedge and add it to the breakout price. You can see here we actually have a little bit of a throwback where the prices are being thrown back into the wedge below the upper rising trend line, but it doesn't take out our stop because our stop is down there at B, or a little bit lower. You should always put a little bit lower. And again, then they took off, and it should at least be able to move up to the peak of the wedge, but it could move even higher. In this case, it actually moved much higher. Another one here is not such a good one. On the surface, it actually looks good because it touched it so many times, but there's a lot of white space, but it didn't really materialize that much. So we have a rising wedge here, broke out of it. You can calculate the distance, so it should actually be able to move even further after a bearish breakout, but it only went around half the length. And that is what we can use the Fibonacci levels for, see if there was any support or resistance in terms of that. But again, the stop should be up here on A, which is the highest peak of the wedge. So that will actually be the stop if we were waiting for this. So it is a fairly bad quality. Here we have another one, and it's actually a current one that is actually evolving at the moment. So it's Spotify on a daily chart. So keep an eye on that. Keep an eye on Spotify if you are a Spotify shareholder or considering being one, or whatever you want to trade this or whatever you want. There is no recommendation or advice whatsoever in this. It's only for educational purpose. But here you have actually a rising wedge. It touched 1, 2, here 1, 2, 3, and actually now 4 times on this side. So let's see how this will evolve over the next few days. If it breaks out to the bearish side, or if it will break out on the continue higher, then it has busted this, and then we have a new situation. But if it breaks out to the bearish side, well, then we can calculate our stops, or we can place our stops. So it will be up here on the highest peak, and we can calculate our target prices and some support and resistance levels, of course. Moving on to cup with handle, and maybe some of you never heard about it, but it actually occurs from time to time, but it's a longer duration kind of pattern, but I think it's important because we actually see it in one of the most traded assets that we have, which we are going to look at in a moment. And I already put up the cup and handle there on the slide, so you can actually see what it looks like. But because it's fairly straightforward, it is It is a round turn or round bottom that looks like a cup. As you can see, that the black zigzag here, that is to illustrate the price movements. So it should look a bit like a cup, and with the handle where we have a bit of a correction. And the rim here is, the rim of the cup, obviously. And we have the breakout price. Price should rise into the cup. It can't come from further up, and then it's not a cup or handle. Then it's just around the bottom. It's something else. It has to be U-shaped, not a V-shaped one. So it has to be fairly round at the end there, and the handle must be on the right side of the cup. Excuse me. The two cup rims should be near the same price level. So we have a rim here on the right side and we have a rim here on the left side. They should be fairly close to each other in terms of the price, but they don't have to be, as I call, pips perfect. There can be a few pips difference, or maybe a few dollars or whatever we are trading here. So what do we do? Well, we have when it breaks out, and it breaks out when it takes out and closes above the right rim, not the left one, the right rim, after a correction. Then you can calculate your target, which is the distance from the rim down to the bottom of the cup, here and here. And then you can calculate the target, and you can add your stop. The stop is the lowest price on the handle. The handle doesn't have to be exactly like I've seen it here, or you see it here, where it's, zigzag down, A, B, C, D, or whatever. It can also be more or less a sideways one in a fairly big range. So we're going to look at an example in just a second. Then you can also, of course, add some Fibonacci levels, which I have also done to some of the patterns that I have detected. And let's have a look at one. I haven't added the Fibonacci to this one, but here you actually have gold on monthly. You can see you have a cup with a handle here. You have the cup, you have the rim, you have the handle here on the right side. Breakout price. Then you add the distance from the rim to the bottom of the cup, and then you have a target price. And I don't think we will reach that, but if you're following my daily videos, you can see that we almost reached the 61.8 or the 786 projection, Fibonacci projection of this cup size here. But again, that is not that important. It is, again, the stop that is important. And here we have the lower part of the handle that is the stop. But I would actually, if it breaks even higher, then I will move my stop up to the last turning point before it breaks out, and so get an even tighter stop. But also a stop that makes sense, because if it takes out that last turning point here before it broke out, if it takes out to the downside, well, the bullish trend has been reversed, and then we have probably a new situation. Then I will just go over very quickly some other patterns that could emerge. It's parallel trend lines, and price actually needs to fit in between two parallel trend lines, either upward sloping or downward sloping, not horizontal, because then it's just, it's not channels, it's just a range trading. And price should trend between those and lines and touch them each at least twice. Let's have a look at an example. A company that I think most of you are actually familiar with, Nvidia daily chart, trading in a rising channel, and it's still trading in there. So either you can trade the trend, or you can wait for bearish breakout. If it does that, we don't know. It can still break out bullish, and then the channel has been demolished, and then we have a new situation. But if it breaks below the lower rising trend line, then you will look for support levels, and that is a last turning point that you will be looking for, support lines. And that's how you do it. You don't actually calculate target prices as such, but you can look for support levels. And again, that is where you see the market turned around. That would be your support levels. Moving on to other kind of patterns. I don't have that many examples. but this is the workhorse. This is what you use. It's especially on very short-term time frames. So flags and pennants are short corrective continuation patterns. As you can see here, market moves up. You have a bull flag. It trades sideways. Or you have a pennant, which is like a triangle-like pattern, and then it moves higher after breaking out. Or you could have a flag pattern like this. It's just you have to learn them, try to draw trend lines. You have rectangle patterns that are sideways moving. You will see pennants are more like triangle or wedges. So they are not necessarily that perfect, but you can use them to try. If you are an intraday trader or very short-term trader, you will see them developing a lot over time. Here we have flags and pennants in the on the arm. We have actually a channel up here, and then you have a flag. If we move back here, you can see a flag pattern here. See, there we have a flag pattern after we have a breakout of a rising channel. Finally, let's have a look at gaps and breakaways, and horizontal support and resistance lines we also going to look at. But I will start with gaps and breakaways. So gaps are important, especially in the equities market. We see them often there. We don't see them that often in FX market, sometimes also in commodities market, but primarily in equities market, where you actually have a closing prices and opening prices, where you have a market that is closing. So what you often see is that here we have Apple, is actually quite a few years ago, but we'll see a few other ones. Breakaway gap, that is the first of breaking out of maybe a sideways trend or something. Moving higher, we have some small gaps on the way also, and then we have a runaway gap where it really takes off, and then we can have an exhaustion gap, but we can have several runaway gaps on the way up, and then market often turns around. But these gaps are also support and resistance levels, and let's have a look at something that you probably all of you know. Micron company, the company Micron Computers, daily chart, it is actually where it's trading more or less as we speak. So over the past few months, you can see gaps here. It actually gapped higher. Market will always at least try to close those gaps. If they fail, in this case, it's a bullish breakaway gap, then it moves higher, and then we have a exhaustion gap in this case here. But these gaps, and here we use body gaps, and when I talk body, it's the body of the candle. Forget about the wicks or the shadows here. So you draw the trend lines from these bodies, and then as you can see, they are actually quite interesting support and resistance levels throughout or into the future. And sometimes, of course, they will be obsolete because they have been broken or whatever. Here we can see suddenly they're dancing around here, testing after the collapse. Well, then it's testing, and then it closes down here again. Then it breaks back above, interestingly, and also turning around at the same price, and then back down here. And now we have a very strong support down here, and we have some strong resistance up here and support here. And this is how you can use it. If you say, okay, market price on Micron is breaking bullish, I don't think it is at the moment, but if it was, just for argument's sake, you will have your stop down here. And this is where I would sit and wait now and say, okay, I want to have a breakout direction. I want to, because I don't know if it's going to break bullish out or bearish out. If it's going to break bullish out, my stop will be down here. If it's going to break bearish out, my stop will be up here. And this is what you can use them for. You can use those gaps and trend lines horizontal. They always 100% horizontal trend lines, or almost 100% horizontal trend lines here. And if it breaks out bullish, well, then that gap up here will be a resistance. And usually the gap on the other side is the strongest one. Sometimes the market will move up above the first one and then try to close it. But there are someone up here that sold off here. They are interested in maybe selling again, so they will start selling before it actually hit that level. But if it closes above and thereby closing the gap, then it's a very strong signal. So this is why you will hear me talk a lot about gaps, especially in the equities market, because gaps are support and resistance levels, and here there are a bunch of them. I kept them all until I can see that they are no more obsolete. Until they are actually obsolete, when they have no meaning anymore. But you can see several resistance levels, and when they are broken, closing above, then they are support levels. All right, that was all I have on traditional technical patterns, support and resistance lines for this. If you are interested in reading more, I recommend you start with Getting Started in Chart Patterns with Thomas Bulkowski, or there's also an encyclopedia of chart patterns also written by Thomas Bulkowski. I regard him as one of the big ones in the chart patterns world, and yeah, check out that. And finally, thoughts, as you probably already know, you find me on Twitter, Kramer's Corner, or here on YouTube, Kramer's Corner TA. Subscribe for free and watch my daily videos, and there will be more educational videos coming your way. That's all. Have a nice day and see you out there.